20% of lower-income Americans believe a standard savings account or certificate of deposit is the single best long-term investment available to them. That is not a misquote. That is Gallup's 2024 Economy and Personal Finance poll. 1 in 5 Americans asked directly to name the best vehicle for building long-term wealth chose a product that has never once in recorded history outpaced inflation over a 20-year window. And while that belief sits undisturbed inside millions of American households, the Investment Company Institute reported that, as of May 2026, retail investors are holding a record $3.08 trillion in money market funds. $3 trillion. Parked. Idle. Treated as a destination rather than a waiting room. Here's the number that connects those two facts into a single problem you can hold in your hands. $10,000 invested at the start of 2004. $500 added every month, left completely alone for 20 years, in a high-yield savings account at the verified average yield of 1.7% over that period, $156,849. In a total market index fund at the S&P 500's verified 9.7% annualized return over the same period, $434,286. Same person, same discipline, same 20 years, same $130,000 in total contributions. The gap between those two outcomes is $277,437. That $277,437 was not lost to a market crash, not lost to fraud, not lost to a bad stock pick. It was lost to a definition, the definition of what investing actually is and the moment it begins, which most Americans have never been given with any precision. That is what this video is about, not a strategy, not a product. One line. The exact line between saving and investing, where it sits, why most people never cross it, and the 3 specific ways the financial industry profits from keeping them on the wrong side of it. Before I show you where that line sits, I want you to hold one image for the entire video because I'm going to return to it at every chapter. Water at 99 degrees Celsius. It is hot. It is uncomfortable to touch. It has been heated by considerable energy input, but it is still water. It obeys the same physical laws as water at room temperature. It sits in whatever container you put it in. It does not expand. It does not generate pressure. It does not move anything. You can pour more energy into it continuously, and it simply remains hot liquid because it has not crossed the threshold. At exactly 100 degrees, the physics change permanently. Steam. The same molecule, the same container a moment ago, now expanding to 1,600 times its original volume, generating enough pressure to drive a locomotive, powering industrial civilization for 2 centuries. Not because you added more energy, because the energy crossed a threshold that changed the fundamental behavior of the substance. Saving is water at 99 degrees. You can add more money continuously. You can shop for the best rate. You can be disciplined, consistent, and patient. But the money obeys the same rules as idle cash. It sits. It does not generate its own pressure. It does not compound against itself. It accumulates without multiplying. Investing is the phase change. The exact moment your money crosses the threshold into productive asset ownership, the rules shift. Not gradually, at once. The money begins generating returns that are independent of your labor, independent of the Federal Reserve's benchmark rate, and independent of how much energy you personally continue to pour in. The question is not whether you want the steam. Everyone wants the steam. The question is whether you have crossed the threshold, and whether the financial industry has a reason to make sure you have not. Keep the boiling point in your head. I am coming back to it. Before the 3 failure modes, I want you to meet someone. David Aris is 41 years old, logistics manager at a supply chain and freight company in Columbus, Ohio. 18 years in the workforce, annual income of $82,000, and by any conventional measure, he has been doing everything right. For 18 years, David has been saving consistently, not spending impulsively, not carrying credit card debt, rolling 12-month certificates of deposit at the best rates he could find, maintaining a high-yield money market account at a legacy bank. He checked the rates, he comparison shopped, he never touched the principal. By 41, David has accumulated $68,000. Last spring, David sat down to calculate a retirement timeline. He wanted to know how close he was to being able to step back from full-time work by his late 50s. He pulled up his account statement and looked at the monthly interest his $68,000 was generating. At 1.7% annual yield, the verified average for top-tier deposit accounts over the last 2 decades, $68,000 generates $1,156 per year. That is $96 per month. 18 years of discipline, 18 years of sacrifice, $36 below the average American's weekly grocery bill, generated monthly by every dollar he had accumulated. Then David's coworker mentioned, casually, that he had invested roughly half of what David had saved, $34,000, in an S&P 500 index fund 5 years earlier, and the account had doubled. David had water at 99 degrees. His coworker had steam. David kept $10,000 as an emergency cash reserve and moved the remaining $58,000 into a low-cost total market ETF. He continued his $500 monthly contribution. At 7% real return over the 24 years between now and age 65, his invested trajectory reaches $681,638. His old cash trajectory over the same period, $279,890 in nominal terms, before accounting for the inflation that will have eroded the purchasing power of every dollar in that account every single year. The phase change David made at 41 is worth approximately $400,000 in retirement purchasing power. He did not earn more, he did not invest more. He crossed the threshold. Hold David, he comes back at the end. The title of this video promises precision. Here it is. Saving becomes investing the exact moment your money purchases a productive asset that carries a statistically verified risk of short-term loss in exchange for the historical certainty of long-term growth. Every word in that sentence is load-bearing. Productive asset, not a loan to a bank, which is what a savings account is. When you deposit money in a savings account, you are lending it to the institution at their offered rate. They take that loan, lend it to borrowers at significantly higher rates, and keep the difference. You are a creditor. You do not own anything. Statistically verified risk of short-term loss. This is the threshold itself. This is the boiling point. Every vehicle that eliminates short-term loss also eliminates long-term compounding growth. The risk is not a flaw in investing. The risk is the mechanism. It is the price of admission for long-term returns and the exact reason most Americans stay on the wrong side of the line. Historical certainty of long-term growth. Not a guarantee on any single year, a certainty across time. The S&P 500 has never delivered a negative return over any rolling 20-year period in its recorded history. The savings account has never delivered a positive real return over any 20-year period of above-average inflation. Both of those statements are true simultaneously. If your money is currently in a vehicle where the institution guarantees you cannot lose the principal, a savings account, a CD, a money market account, a treasury bill, you are on the saving side of the line. You are at 99 degrees. You have not crossed. Now let me show you the 3 ways the industry makes sure you stay there. The most effective mechanism for keeping Americans on the saving side of the line is a single word: yield. High-yield savings account, high-yield money market fund, high-yield CD. The word high is doing enormous work in all 3 of those phrases, and it is working entirely in the institution's favor. At the peak of the recent rate cycle, top-tier savings accounts were offering 4.5 to 5% annual yield. This felt significant. For the first time in over a decade, savers were receiving a return that seemed worth celebrating. Here is what was happening simultaneously. Inflation over that same period was running between 4 and 8%. At 5% yield against 6% inflation, a saver was losing 1% of purchasing power annually and calling it a win because the nominal number went up. The account balance grew, the purchasing power of that balance shrank. This is the yield illusion in its purest form. A savings account, denominated in dollars, measures its return in dollars. Dollars are not a fixed unit of value, they depreciate. A return measured in a depreciating unit that does not account for that depreciation is not a real return. It is a nominal number that feels like progress while quietly moving backward. There is a woman I want to tell you about, Sylvia Bloom. She was a legal secretary from Brooklyn who spent 67 years at the same law firm on a modest secretarial salary. Every day, her bosses, the firm's senior partners, would instruct her to execute stock trades for their personal accounts. And Sylvia did something that nobody at the firm knew about for decades. She mirrored every trade. Whenever a partner bought shares of the company, Sylvia bought the same shares for herself. Smaller quantities, same stocks, same principle, crossing from the creditor side of the line into ownership of productive assets. She never announced it. She never discussed it. She simply stopped storing her labor in a depreciating currency and started converting it into fractional ownership of profit-generating businesses. Sylvia Bloom died in 2016 at 96. Her estate was worth over $9 million, distributed across 3 brokerage houses. The New York Times broke the story in May 2018. Her colleagues at the firm were stunned. Her neighbors assumed she had lived and died on a secretary's salary. Sylvia understood the yield illusion without being able to name it. She understood that the number on the savings account statement was not the number that mattered. The number that mattered was what the productive asset generated across decades of ownership. The corrective bearing for failure mode 1. Stop measuring your return in dollars. Measure it against the trailing 12-month CPI. If your yield is below inflation, your real return is negative. You are not earning, you are losing, more slowly than you would if you held cash under a mattress, and you are calling it investing. Hit subscribe if this is landing the way I intend it to. YouTube does not reliably surface content like this unless people engage with it. I would rather you find the next video than miss it. I want to return to the number from the opening, because most people hear $277,437 and process it as a large abstract figure. I want to make it concrete. 2 people. Both start in January 2004. Both have $10,000 saved. Both contribute $500 every month without interruption for 20 years. Both are disciplined, consistent, and patient in exactly equal measure. Person A keeps everything in the best savings vehicle available, earning the verified 20-year average of 1.7% annually. Person B puts everything into a total market index fund, earning the verified S&P 500 return of 9.7% annually over the same period. By the end of 2023, Person A, $156,849. Person B, $434,286. Open a compound interest calculator right now. Type $10,000 starting balance, $500 monthly, 9.7% annual compounded monthly, 20 years. You will get $434,286. Then run the same calculation at 1.7%. You will get $156,849. The calculator will give you the same numbers because we are using the same verified inputs, and there is no version of this arithmetic where the result differs. Person B did not make a single investment decision after the initial one, did not time the market, did not pick stocks, did not rebalance aggressively, simply crossed the line from saving to investing in January 2004 and did not cross back. $277,437 is the price of the line. At a recent holiday party, An uncle cornered me to share what he described as a discovery. He had found a savings account offering 4.5%, and he was delivering the information in the hushed, conspiratorial tone of someone who had cracked a cartel safe. What he had not considered was the mechanism behind that 4.5%. His deposit arrived at the bank. The bank immediately lent a portion of it to his neighbor for an auto loan at 8%, pocketed the difference, used another portion to fund a mortgage at 6.5%, pocketed that difference too, extended a credit card line at 22%, kept that spread entirely. My uncle was throwing a parade because the bank was paying him a participation trophy in a game where they owned the stadium, the referees, the concession stands, and every dollar of spread between what they paid him and what they charged everyone else. It is the only industry on earth where they rent your tools, use those tools to build a house, keep the house, sell it for 3 times what they paid, and then hand back the hammer with a ribbon on it and expect applause. The bank is not your savings partner. The bank is your tenant. They are renting your capital at 4.5% and subleasing it at multiples of that rate. The moment you understand that relationship, the appeal of the high-yield savings account changes character permanently. The second mechanism that keeps Americans at 99 degrees is the one they think of as their greatest financial virtue: liquidity. Zero volatility, full accessibility, no risk of loss. These 3 features of savings accounts are marketed as benefits. They are, over any period longer than 3 years, structural liabilities. Here is why. Liquidity has a cost. That cost is the risk premium, the additional return that productive assets generate specifically because they carry short-term volatility. The moment you demand a guarantee that your principal cannot decrease, you are contractually excluding yourself from the asset class that generates long-term real returns. You have eliminated the risk and simultaneously eliminated the return that the risk produces. I want to tell you about someone I will call Marcus, IT network specialist, Denver, Colorado. From age 35 to 50, Marcus put $1,000 a month into what he called his wealth building account, a separate high-yield savings vehicle that he never touched. He was meticulous about it. He believed he was an investor because the account was designated for the future and he never spent from it. He was not an investor. He was a disciplined saver who had named his savings account something that sounded like investing. At 50, Marcus sat down with a fee-only fiduciary planner to discuss shifting to part-time work. The planner mapped Marcus's yield against real inflation data over the previous decade and said, without softening it, "Marcus, you haven't been investing. You've been hoarding depreciating tokens." The math behind that assessment? 15 years of $1,000 monthly contributions at 1.7% average yield produced $204,867. The same contributions into a total market index fund at the S&P's verified 9.7% return over the same period would have produced $403,237. Marcus's belief that liquidity was a virtue cost him $198,370 in foregone growth. He moved 80% of his cash into a total market index fund. He experienced acute anxiety for 3 months and checked the balance daily. Then, one quarter, his automatic dividend reinvestments purchased additional shares without requiring a single dollar from his paycheck. The phase change had occurred. He had crossed into steam. The corrective bearing for failure mode 2. An emergency fund of 3 to 6 months of living expenses belongs in cash, fully liquid, fully accessible. Every dollar beyond that threshold has no logical reason to prioritize liquidity. The productive asset is not going anywhere. You can sell it if you need to. The liquidity premium you are paying by keeping it in savings is not insurance. It is a fee you are paying to stay at 99 degrees. The third failure mode is the most psychologically insidious because it masquerades as success. Most Americans measure their financial progress by the size of the number in their account, not the purchasing power of that number, not the trajectory of that number, just its size. And savings accounts are very good at making that number grow in nominal terms while it quietly shrinks in real terms. This creates a specific and painful outcome. People who have won the accumulation game and lost the wealth game simultaneously. They have a large number. They have spent years building it. They feel the pride of discipline and patience. And then they run a retirement projection and discover that the large number, measured in real purchasing power across a 30-year retirement, is not large enough to sustain the life they were building it for. This is what I mean by winning the wrong game. The savings account told them the score. The score was going up. They felt like they were winning. But they were playing a game where winning produces a different outcome than the one they needed. David Aris understood this at 41 when he calculated that 18 years of disciplined saving had produced $96 a month in interest. He had accumulated $68,000. The accumulation was real. The number was real. The ability of that number to generate meaningful retirement income was not. The corrective bearing for failure mode 3 is to change the scoreboard entirely. Stop measuring progress in nominal account balance. Start measuring it in projected annual income at retirement. Take your current balance, add your projected contributions, apply a historically grounded return rate, and calculate the 4% withdrawal figure at your target retirement age. That number, the annual income your accumulated wealth can sustainably generate, is the score of the game that actually matters. A $68,000 savings account at 65 generates $2,720 per year at 4% withdrawal. A $681,638 invested portfolio at 65 generates $27,265 per year. Same starting point, same discipline, different game, different score, different life. Let me bring David back. Age 41, Columbus, Ohio, 18 years of consistent, disciplined, patient saving. $68,000 accumulated. $96 per month in interest. A coworker with half his balance and double his trajectory. David made one decision, not a strategy overhaul, not a career pivot, not a windfall. He crossed one line. He moved from the creditor side of the financial system to the ownership side. He shifted from storing depreciating currency to owning fractional stakes in productive assets. $10,000 stayed in cash as his emergency reserve. $58,000 crossed the threshold into a total market ETF. $500 a month continued flowing in, now into the same ETF. At 7% real return over 24 years to age 65, $681,638. His old trajectory, cash accumulation at 1.7% over the same period, would have produced $279,890 in nominal terms. Before inflation reduced the purchasing power of every dollar in that account across 2.5 decades. The phase change David made at 41 is worth approximately $400,000 in retirement purchasing power. He did not find a new income stream. He did not take on risk he could not afford. He crossed the line that 20% of Americans believe does not need crossing, because they have been handed a definition of investing that keeps them permanently at 99 degrees. The water did not change. The threshold changed. And on the other side of it, the same molecule that had been sitting still for 18 years started generating pressure. The mountain does not reveal itself to the patient observer. The phase change does not reward effort. It rewards crossing. Sylvia Bloom crossed it every time her boss placed a trade, replicating the exact same ownership position in smaller quantities on a secretary's salary for 67 years. She died with $9 million and nobody knew. Marcus crossed it at 50 after a planner told him in plain language that discipline without direction is not investing. He spent 3 months watching the balance anxiously before he saw a dividend reinvestment purchase shares without his paycheck. David crossed it at 41 with $68,000 and a calculation that showed him $96 a month, and the coworker who had half as much and twice the trajectory. The line is not complicated. It is not hidden. It is not accessible only to people with financial credentials or high incomes or insider knowledge. Saving becomes investing the exact moment your money purchases a productive asset that carries a statistically verified risk of short-term loss in exchange for the historical certainty of long-term growth. That sentence contains the entire argument of this video. The risk is not the enemy. The risk is the threshold. The risk is the boiling point. The moment you accept short-term volatility in exchange for long-term compounding, the physics of your money change permanently. $277,437 is the cost of staying at 99 degrees for 20 years. The degree that separates hot water from steam is not a large number. It is not an intimidating number. It is 1 degree. And on the other side of it, the locomotive moves.